Good evening everyone, Rahul Chaudhary here. Today is 7th May 2026. Let's get started with today's macro analysis. So today's market wasn't just another risk on rally. Under the surface, we may be witnessing the beginning of a major macro transition. Let's break it down institutionally, but in a way that even actually a retail trader can also apply. The biggest catalyst of the day was the sudden proposal of peace around the Strait of Hormuz today. Market immediately priced out the geopolitical fear. Brent crude collapsed near 7%, the inflation expectations dropped, and equities rallied hard. Now the retail traders will look at this and say, oil down, stock up. But the institutions thinks differently. The real question is, what does falling oil do to the central bank behavior? And the answer is very critical. The cheaper oil reduces the inflation pressure. That gives the Fed more flexibility later this year. Not necessarily rate cuts immediately, but it definitely reduces the probability of further tightening. And that's why the money rotated aggressively into AI and growth names today. And this is a classic institutional rotation. The capital is moving from inflation trades to back into duration trades. And if you don't understand this rotation, you will always be late. And here's where the things get more interesting. The labor market data from the US came in stable, not too strong, not too weak, and that's exactly what the Wall Street wants. Why? Because a strong labor market keeps the economy alive, but the cooling wage pressure keeps inflation under control. And this is the definition of a soft landing narrative. But there is another trade the institutions are looking very closely, and that is the Japanese yen. The Bank of Japan officials are becoming more hawkish. Japan is no longer comfortable with extreme yen weakness. Global hedge funds use the yen as cheap funding for carry trades. Now imagine this. If Japan starts tightening while the Fed eventually normalizes the policy, that entire carry trade starts unwinding. And that can create violent moves across forex, equities, bonds globally. This is not a retail level story anymore. This is a global liquidity repositioning. And now let's talk about the positioning. Hedge funds are heavily crowded into AI trades. Exposure is near extreme levels. That means market can move higher. But the margin for error is becoming very thin. Just 1 week at least. Either bad payrolls, hot inflation, or geopolitical escalation. And you will see institutions de-risking immediately. And that's why the serious traders should stop thinking in the terms of bullish or bearish. Think in probabilities, think in liquidity, think in positioning. And that's how the institutions survive. This is not the environment for emotional trading. This is an environment for precision, patience, and execution. I am Rahul Chaudhary. Follow for institutional grade macro and forex analysis designed for serious traders only. Trade in probabilities, not emotions. That's all for today. Thank you.